3 years ago, every real estate investor in America was fighting to get into Phoenix. Prices were climbing, rent demand was surging. It felt like the market would never cool down. Fast forward to today, and the city that nobody was watching just ranked #1 on the National Rental Demand Index. That city is Cincinnati, and the money is already moving. To understand why this matters, you need to see the bigger picture. Between 2020 and 2023, the Sun Belt was the only story in real estate. Phoenix, Austin, Tampa, Boise, every investor, every fund, every newsletter was pointing in the same direction. And for a while it worked. Prices climbed, rents climbed, the returns were real. But here is what happens when an entire market moves in one direction at the same time. Supply responds. Builders broke ground on tens of thousands of new units across the Sun Belt. Cities that had never seen this level of construction activity were suddenly flooded with inventory. And when supply catches demand, the math changes fast. This is not a theory. This is what is playing out right now in multiple Sun Belt metros, and the investors paying attention have already started to reposition. Let us look at Phoenix specifically because it is the clearest example. During the pandemic, Phoenix was the poster child for Sun Belt migration. Remote workers flooded in from California. Investors followed the population data. Between 2020 and 2023, median home prices jumped over 40%. The average rent for a single-family home climbed past $2,000 a month. Vacancy rates were near historic lows. Every metric pointed up. But then something shifted. Builders responded to all that demand by constructing thousands of new units. Multifamily permits exploded. And by late 2024, supply started catching up with demand. Rents flattened. Then they started falling. Vacancy rates climbed above the national average. Investors who bought at the peak found themselves holding properties where the rent no longer covered the mortgage. Insurance costs spiked. Property taxes followed the inflated valuations. And the cash flow that looked so attractive on a spreadsheet in 2022 turned negative by 2025. The math that made Phoenix attractive 3 years ago simply stopped working. And Phoenix is not the only market where this happened. Across the Sun Belt, large institutional investors started selling. And this is where it gets really interesting. Research from Parcl Labs shows that in every major metro, investors now make up a larger share of for-sale listings than they do of the total housing stock. In Dallas, investors own about 9% of homes but account for nearly 23% of new listings. In Atlanta, they are selling almost 2 properties for every one they buy. In Houston and Philadelphia, the pattern is the same. The largest investors, the ones with dedicated research teams and proprietary data, are exiting positions they built during the pandemic. This is not a crash, this is a strategic repositioning. The big players are locking in gains from the pandemic-era run-up and redeploying capital into markets with better fundamentals. They are not panicking, they are reading the data and acting on it. The question every smaller investor should be asking is not whether the Sun Belt is over. It is, where is that capital going, and more importantly, can you get there first? Cincinnati was not on anyone's radar 2 years ago. That is exactly what makes it interesting. RentCafe's 2026 Trending Rental Markets report put Cincinnati at #1 in the country. Not Miami, not Austin, not Nashville, Cincinnati. The number of apartments favorited by prospective renters jumped 81% year over year. Saved searches climbed 14%. Page views rose steadily through late 2025. And this was not a fluke. The demand signal has been building for over a year. But the demand signal is only half the story. Here is why the numbers actually work. The median home price in the Cincinnati metro sits around $260,000. In Phoenix, that same metric is closer to $430,000. That gap means your down payment, your mortgage, and your carrying costs are dramatically lower in Cincinnati. The rent-to-price ratio tells you how much monthly rent you collect relative to the property value. In Cincinnati, this ratio is among the strongest in the Midwest. In Phoenix, rising prices and falling rents have compressed this ratio to the point where cash flow is difficult without a large down payment. Cincinnati also has a diversified economy. Major employers include Procter & Gamble, Kroger, Fifth Third Bank, and a growing healthcare sector anchored by several major hospital systems. The cost of living sits 7% below the national average. Unemployment tracks below the national rate. And unlike Phoenix, where new construction flooded the market, Cincinnati's housing supply remains relatively constrained. The city did not see the same building boom that hit the Sun Belt, which means the supply and demand balance still favors landlords. The combination of affordable entry points, strong rental demand, and limited new supply is exactly the formula that made Phoenix attractive 5 years ago. The difference is that today, this formula is still intact in Cincinnati. The herd has not arrived yet. Let me show you what $200,000 in capital looks like in each market. This is the comparison that matters. In Phoenix, $200,000 gets you a property around $400,000 with a conventional loan. At current rates, your monthly mortgage payment is roughly $2,400. Average rent for a comparable property is around $1,900. Before expenses, you are already negative $500 a month. Add property management at 8 to 10%, maintenance, reserves, insurance, and vacancy, and you are subsidizing this investment out of pocket by $700 to $900 every month. That is not an investment. That is a liability with a hope of future appreciation. Now look at Cincinnati. That same $200,000 covers 2 properties at the median price with 20% down on each. Your mortgage payment on each is around $1,300. Average rent is approximately $1,500. That gives you positive cash flow of roughly $200 per door before expenses. With 2 doors, you have $400 a month in gross cash flow and actual equity diversification. After expenses, you're still in positive territory, same capital. One market puts you underwater, the other puts you in the green with 2 income-producing assets instead of 1. This is why the money is moving. This is why the data matters more than the headlines. Now I want to be honest about the risks, because no market is without them. Cincinnati is not a growth market in the way Phoenix was. Population growth is modest. You are not going to see 30% appreciation in 2 years. That is not the play here. The play is cash flow and stability. There is also the reality that some neighborhoods in Cincinnati carry higher risk than others. Like any Midwest city, there are pockets of vacancy and decline right next to pockets of strong rental demand. You cannot buy blindly based on the metro-level data. You need to go neighborhood by neighborhood. Property condition matters more in older Midwest housing stock than it does in newer Sun Belt construction. Inspection costs, renovation budgets, and maintenance reserves need to be higher in your underwriting. And finally, property management at a distance requires a reliable local team. If you are investing from out of state, your returns depend entirely on the quality of your property manager. These are solvable problems, but they are real, and you should factor them into your decision before you write a check. Cincinnati is not an isolated case. It is part of a broader pattern that researchers are calling refuge markets. These are cities that become attractive when buyers get priced out of major metros. They share 3 characteristics: median home prices below $300,000, rent-to-price ratios that still support cash flow, and diversified local economies that are not dependent on a single industry. Indianapolis has a strong logistics and healthcare base with median prices around $250,000. Columbus benefits from Ohio State University and a growing tech sector. Birmingham offers some of the highest rental yields in the country with entry prices under $200,000. And Memphis, despite its challenges, continues to attract cash flow investors with some of the lowest price-to-rent ratios in America. The investors who identified Phoenix in 2019 before it became obvious are the same profile of investors looking at these markets today. The difference is that right now, the entry price is still low enough for individual investors to compete. You do not need a billion-dollar balance sheet to buy a duplex in Cincinnati. 3 things to take away from this. 1. By the time a market is obvious, the best returns are already gone. Phoenix taught that lesson to thousands of investors who bought at the top. 2. Follow the data, not the hype. Rental demand indicators, migration flows, and rent-to-price ratios will tell you where opportunity is building before the headlines catch up. 3. The advantage of being a smaller investor is speed and flexibility. You do not need committee approval. You do not need board votes. You can enter a market like Cincinnati today while institutional capital is still repositioning and the big funds are still writing their internal memos. If this kind of analysis is useful to you, subscribe. Every video on this channel breaks down real estate markets using data, not opinions. No hype, no guru nonsense, just the numbers and what they actually mean. I will see you in the next one.